success can be a long journey for many financial analysts. You already know a lot about the balance sheet and the income statement. What do you think connects these two? Yes, that's right. The net income figure for the year. It is calculated as revenue minus expenses in the income statement, and then accumulated as retained earnings in the balance sheet. However, the profit figure is not the only key indicator of business performance. An integral part of a firm's financial well-being happens to be its cash flow position. How so? Think about it. From an analytical standpoint, the income statement might show that a company is quite profitable, but then you notice it's running low on cash, and you can't help but envision major shortages. Unfortunately, many firms fail to recognize the difference between profitability and liquidity, and in doing so, expose themselves to huge risks. For an entrepreneur, one thing that is worse than a cash flow squeeze is a cash flow squeeze that happens when the business is growing. Imagine you browse through a firm's income statement and you see it earns a profit. For the last reported year, its net income amounts to $1 million. That's great. However, in the next 30 days, the company needs to repay a portion of its debt equal to $500,000. At first glance, the business is doing fine. Most of its revenues and expenses have been collected and paid on time. Nevertheless, it's yet to collect $750,000 from two of its big clients. Hence, a big portion of total receivables is now overdue. As a result, the firm has only $250,000 left in its bank account, which is still insufficient to cover the debt obligation. At the same time, two clients continue to delay their payments. So, is this a profitable business? Yes, it is. Does it have liquidity issues? It certainly does. If the company can't collect some cash from these two clients, it runs the risk of being unable to repay its loan on time, which, by definition, makes it insolvent. Therefore, the survival of an entity predominantly depends on its ability to pay its obligations when they fall due, rather than striving for profits at the expense of cash shortages. This is just one of the myriad examples out there proving the significance of having cash and cash equivalents at the ready. Companies' performance and prospects practically stem from the ability to balance their profitability and liquidity indicators. The latter go hand in hand with the firm's cash position throughout the reported period. And what better way to keep an eye on all this than to set up a separate financial statement? As such, the cash flow statement identifies the cash that flows in and out of an entity and points out where it is generated and spent. It shows whether day-to-day operations bring enough cash to sustain the business, to pay the outstanding financial obligations and interest expenses. It also tells us how much has been invested so far, along with a company's liquidity and resourcefulness to take advantage of new business opportunities as they arise. That's why it plays an important role in budgeting and forecasting as well. Needless to say, the use of the cash flow statement is very much in sync with the rest of the financial reports. Above all, users can gain further appreciation of the change in assets and liabilities, or scratch the surface of an entity's liquidity and solvency positions. By the same token, we can see an organization's ability to adapt to changing circumstances by adjusting the amount and timing of cash flows. In other words, projecting the cash flow will enable a firm to predict and possibly prevent unfavorable scenarios in the future. Essentially, understanding how the cash flow statement functions is your bread and butter in budgeting. You should understand that profitability and growth potential are worthless without cash-generating abilities. Therefore, it's critical for you to learn how to draft projected cash reports properly.